Good morning and welcome to our very first podcast, In Conversation With. Thank you for taking the time to join us. I'm Mark Abley, Managing Director here at Fathom. Today I'm joined by Dan Norman, the CEO and Joint Founder of TCF Investment. Good morning, Dan.
Good morning.
Thank you for agreeing to be our very first victim, or should I say guest.
Thank you.
Many of the people watching here today will be familiar with TCF Investments as they run the MAPS portfolios. For those of you who have read Dan's bio, you'll know that he's had a number of very high-profile roles in financial services. Dan, you were CEO at Credit Suisse before founding TCF.
Yeah.
That's just about the highest profile role that anyone could have in our world, sort of financial services. So what was the driver behind giving up the dream job and starting TCF?
Two things, if I'm honest. One, I left just after the credit crunch, so there was a need to do something quite radical to the business. So we actually sold the business off.
Okay.
And the other thing, I guess, which had been underlying my thinking for quite a long time, there are some very, very clever people employed in the financial services industry, but sometimes they lose sight of the customer. So they're very clever at designing products and taking risk, but designing products and taking risk with other people's money. And for a long time, I'd held the view that I just want to design some simple, straightforward products, that were smart. Had good investment principles and sound investment principles, but actually delivered really good value to the customer. So in some ways, the move enabled me to kind of make that transition, which is great.
Oh, excellent, great. So what are the guiding principles, Dan, that you use when you're investing other people's money?
Investment is quite simple, but it's not easy. So there's some really sound principles that, in fact, anybody investing you should take. Advice is really valuable. Understanding what you're planning for is critically important. If you came to me and said, Dan, here's £10,000, how should I invest it? My first question is going to be, what's it for? You need to have a long-term plan in terms of what you want to do with the money. So advice is really important, particularly now around pensions, because it's so complicated and there are so many different tax rules and contribution rules, amounts you can pay in and what you can't pay in. You can think you're doing a good job and actually get yourself in a real muddle. The next piece is to get your asset allocation right. So the mix between equities and shares and bonds. In the long run, equities do much better. So you kind of want to have as much in equities as you can, but of course they do better because they're more risky. So actually you need other assets, bonds, that are less risky to try to get the right balance. So depending on your time horizon, and that's what financial advisors will do well. I guess the other things, keep it low cost. Good value rather than just cheap. Yeah, some cheap things aren't great. You can buy cheap petrol, but it may not go as far as good petrol. So get the balance right. Don't put all your eggs in one basket. I see people who, I'm doing really well. I've invested all my money in gold. It's gone up a lot, and then suddenly they go very quiet. All your eggs in one basket is not the right way to do it.
Great. So you mentioned that, Dan, things like equities and bonds and gold, as we would call those asset classes. So how do you select the mix between them? How do you determine where to stuff that money in a portfolio?
Okay. It varies. But there's kind of two elements. One is we can look backwards at history, and see what different asset classes have done over time. So there's data going back over 100 years for most equity markets, slightly less over bond markets. And so the different asset classes will have performed in different ways. So we can see what they've done historically. We can understand why they've done that. And then we can look forward in terms of, so what's going to be the same going forward as was in history and what's going to be different. So a simple example at the moment. Bonds work like seesaws. As interest rates go down, bond prices go up. So interest rates have been coming down and down and down for the last, since the credit crunch in 2008, 13, 14 years. So bond prices have gone up and up and up and up. So bond investors have done really quite well. Now you could say, well, if I look back 10 years, bonds have done really well, I'll invest more in bonds, but they're now really expensive. So perhaps now is the time to be saying they're very expensive. Maybe I need to be cutting my exposure. So we take long-term historic information and look forward and try to build portfolios with different risk profiles. So a lower risk investor would have slightly more in bonds, a higher risk investor with slightly higher returns, but we allow the advisor to choose the right portfolio for the investor.
Okay, great. Well, that leads me quite nicely to the next question. You know, what process do you use to select the funds within the portfolios, and how do you do your due diligence? What do you look for?
Yeah. Okay. I guess rigorous simplicity is the simple answer. Does it do what it says on the tin? So, you know, if I'm looking at a fund that's that's a UK equity fund, what's the benchmark the fund manager is using? How close are they to the benchmark? What's their performance being compared to the benchmark? Whether I'm using an index tracking fund or an active fund, I want to know what the manager is doing and how they're doing it. What's the structure of the product? There are some products in the market at the moment that are almost zero cost, but they're based in Europe. There's a French company with a German subsidiary running a complicated structure with a derivative underneath. If in doubt, kick it out. So we spend a lot of time to try to make it really, really simple and straightforward. I'm trying to look after the money for our investors as if it was my mum's.
Okay.
So she may not need to understand it all, but she needs to know that somebody does understand exactly what's going on underneath.
Okay. And I guess keeping it simple, Dan, helps to keep the costs down.
Yes. I mean, we are 20 years ago, most retail investors were buying actively managed funds. Yeah. Today, more and more money is going into passively managed or index trackers. We think they're really good value. If you can put together a portfolio of low-cost trackers and then move a little bit, you know, whether you want to be in equities or bonds, so we can get a low-cost portfolio but still add value. Probably 10 years ago, I mean, a fund of fund, so a portfolio that most investors might buy, could easily be 2.5% per annum plus other costs. Yeah. Today we're running portfolios at 0.4. Yeah. So much lower cost. And if you take less out, unsurprisingly, there's more left in.
Yes, for the investor. Yeah,
absolutely.
Yeah. Okay, Dan. Over time, we've spoke quite a bit about your investment processes, and in particular your investment committee, and we see the minutes from the committee meetings and things. Can you tell us a little bit more about the investment committee and the composition of it, and what it does, and how much influence they have over the decisions that you make as a fund manager? Yeah.
Okay, so we've taken the decision to have an independent investment committee. So it's chaired by somebody independent of the business. He has many years of experience in the industry. And that's what we've tried together. We've brought together people that have both expertise and experience. So they've been around a while and seen things. But we also have people with different perspectives. So, for example, James's background is an equity research analyst, so he's done an awful lot of work researching underlying companies. Okay. So he knows how companies work and how markets work. Rasheen was a former chief investment officer for an asset management company, so she's more concerned about long-term trends and macroeconomic trends and what's going on. So we bring that expertise together. Bob's was at Hill Samuel and Lloyds Bank before, looking after corporate pensions clients, so has a very much a customer perspective. So it's those different perspectives that help us to kind of make our decisions. Everything that we invest in is approved by the investment committee. So we effectively bring to them on paper and say, we would like to now invest in XYZ fund. Here's why. Here's the work we've done. Most often things are approved, but quite often the committee they'll just ask us the dumb question. And that's, I guess, one thing about investment. There's no such thing as a dumb question when it comes to investing your money. So they'll make us go away and do a bit more research. Example, most recently for quite a large, well-known fund management business, we were looking at one of their funds. The research document is 38 pages long. So there's quite a lot of research goes on. We really want to understand what's underneath.
Yeah. So do they influence where you allocate money within the portfolios as well, Dan?
Yes, so we have a long-term benchmark, what we call the strategic asset allocation. Yep. So a risk profile 3 is slightly less risk than a risk profile 4, etc. So the long term, we know where we want to go. but then they help us make the decisions about how do we want to move. So I talked about equities and bonds before.
Yeah.
Our view is bonds are expensive. So at the moment in our portfolios, the committee has helped us decide that we should be slightly underweight. We've got slightly less in bonds than you would normally have.
Yes.
Because they're higher risk, slightly more in cash as a result.
Yeah. Okay. I'm conscious that you're not an advisor, so you're an investment manager, but what would be your top tips for investors?
Well, the first one is definitely get some advice. Yeah, understanding your financial plan and what you're trying to do with the money in the long term is really quite important. And human beings, we have a lot of good attributes, but we're not very good at thinking long term. Yeah, there's a lot of work done on behavioral finance, the way people behave with money. We like to look at the short term. We put a lot more emphasis on the short term than the long term. So when it comes to investment, we're not very good at making those long term decisions and looking at inflation and the impact. So a long term plan is definitely important. Okay. Be aware of risk and return. Yeah, if something is done really well, always turn the chart the way they are. It could be it's done well because it takes more risk. So understand risk and return. Keep it simple. The trouble with trying to keep it simple is in the UK today, there's about 9,000 different funds to choose from. So actually, if you wanted to start, how on earth do you start with the 9,000 funds? And that's what we hope to add in terms of our value, is doing a lot of that work and that selection and ongoing monitoring on a constant basis. And don't panic. The stock market will tick along quite happily for 5 or 6 months, and go up in value, and it doesn't appear on the news at 10. It drops by 5%, and the world ends. Billions have wiped off the stock market. Everybody panics. If you look around the world at nearly every market, there's a very strong correlation. So as stock markets go up, people invest more money. So as things are getting more expensive, they're buying more of them. And unsurprisingly, when things suddenly get cheap, they sell them. That's the wrong way round. You've got to be bold to be an investor that sells when things have gone up and buys when they're cheap. But that's the right way to make money in the long run.
So cheeky question, Dan. Where do you invest your money?
Well, unsurprisingly, in the MAPS model portfolios.
That's good.
It's a really good question to ask fund managers. Is your money where your mouth is? Yes, my money is where my mouth is. I have 2 little risk profiles in my pension fund. One for some slightly shorter term money, so when I first retire, and then hopefully for money, for slightly longer term. I do have, as most investment managers do, a little portfolio that I play with, and occasionally it does very well, and occasionally it does the other thing. So keep it simple and straightforward is definitely the right answer. Good.
So no interview with a fund manager would be complete without asking for your view on the market. And there's lots and lots going on in the world at the moment. We've still got Brexit. We've got the US presidential elections. So what do you see on the horizon, Dan?
It's a good question. I think the first thing to say is people like fund managers to give their views and their forecasts. Forecasting is incredibly difficult. And probably there's a great quote, forecasting tells you more about the forecaster than the actual forecast. There were lots of economists recently when we were going into COVID telling us what shape the economy was going to be. If you asked 27 economists, you got 28 different views. So be careful about forecasting. Adapting is a slightly different thing. So looking at what's going on and why things are changing and how they're changing, and therefore how you want to be positioned in that, I think is a better way of doing it. That said, you're right, there's a lot going on. There's the possibility of negative interest rates. We've already got them in some of the institutional bond markets. So if you want to lend Mrs. Merkel, 100 euros, you have to pay her 2 euros for the privilege of giving her 100 euros to look after. Don't expect banks in the UK to start paying your mortgage anytime soon. China and the US trade tensions, that was a big issue earlier in the year. That's gone quiet, largely because of COVID. People have got other things to worry about. Europe seems to be getting its act together in terms of recovery plan. It's committed 750 billion euros to help raise, to stimulate the economy. That's a good sign. China is doing well. US election you've talked about. Markets don't like uncertainty, and nobody knows the answer to that one. I read that Joe Biden has the same lead that Hillary Clinton had before she lost the last one. So that's not telling you much.
No.
The biggest risk there is probably that it's a very close run thing, and America being very litigious, you start getting to this endless argument about the vote and this and that could be that would be the worst outcome. Is just uncertainty. We need a good answer one way or the other.
Yeah.
The US is very expensive as a market. 25% of the US stock market is now dominated by the FANGs, by the 5 big tech companies.
Yes.
In fact, I think 2 of them now are bigger than the FTSE 100. So each of those individual companies. So that's quite expensive. I guess I wouldn't be complete without a comment on Brexit. Our view is that eventually sense will prevail. Well, some sort of sense, and a deal of sorts will be agreed, but it will be a deal that, as with most of these negotiations, allows them to keep having conversations further down the road. I think Switzerland is still agreeing with the EU exactly what its agreement was, and that was struck 25 years ago. Yeah, so Brexit is going to be with us for a long time. It makes sense for both parties to come up with some sensible deal, because otherwise they are just literally shooting themselves in the foot.
Yeah, well, I think this morning they've reopened the negotiations, I think.
Yeah. Well, and that's deadlines are there to be missed.
Yes. Yeah.
That's it seems so.
Well,
yeah. So at the moment, I think what's going on at the moment? Governments are borrowing lots of money, but it's very cheap to do because interest rates are very low. At some point, that will need to get repaid. When that starts to happen, interest rates will start to go up. That's not going to be good news for bonds, and we might start to get some more inflation. But we're a little way away from that just yet.
Okay, we've got a couple of questions, Dan, that have come in from audience members. We've got one that relates to negative interest rates. Cracking question. The Bank of England have made some utterances about negative interest rates. What would be the impact of that here?
Banks won't start paying off your mortgage or your credit card, so that's for certain. The theory would be is if people are holding cash and not investing, that's slowing the economy down. So if you create negative interest rates, it makes sense for people to say, I'm not going to invest my cash, I'm going to invest it. So the whole idea behind negative interest rates is to kind of stimulate the economy. Would that work? Are people going to worry about going from 0.1, which is what most people say, or 0.01, to a negative interest rate? Even if the banks can actually facilitate that, will that make a lot of difference? Opinions divided. It's more for the banks. So the actual banks themselves, that if they're depositing with the Bank of England and get negative interest rates, it's much better for them to invest, i.e. to lend money. So the idea behind it is that banks will cut their interest rates for loans and encourage people to invest. The theory is fine. Are people going to invest a lot more money in the current environment? Uncertain. So I suspect it's more about the Bank of England signalling that it's keen to keep interest rates low than actually physically have negative interest rates. And of course, as a saver, it's important. Unless the Bank of England makes it illegal, I suspect there'll still be some bank somewhere going, here's a great opportunity to have some positive interest rates and actually win lots of new customers. So, as ever, shop around. Yeah,
great. Another question here. Lots of governments around the world appear to be printing lots of extra money just right now. They all seem to have magic money trees.
Yeah.
In the case of the UK, I mean, back in the 70s, we had to go cap in hand. The government went cap in hand to the IMF, the International Monetary Fund. Is there a danger that could happen again because of the current environment?
I think it unlikely. In interest rates, so money's being borrowed now at tiny interest rates, and even in some parts of the government bond market at negative interest rates. So actually, it's very, very cheap borrowing for governments. It's surprising in many ways. If you talk to economists 10 or 15 years ago about we were going to have interest rates cuts that we've had, they would have said you won't have those because you'll get inflation. That will stimulate the economy and growth will come through, and then we'll get inflation. So at some point we will get that inflation, and inflation is great for governments because it wipes out their debt. So having very, very low interest rates that you're paying and actually a little bit of inflation is going to help. I don't think the UK government will go to the IMF for the bailout. I think it will go to taxpayers. It's not keen to do it because it needs to get the economy going, but I suspect we'll see some fairly subtle but fundamental changes in tax policy over the next few years.
Okay, and we hear lots of noise in the news about GDP.
Yeah.
So the next question's sort of double-barreled, really. Could you just explain simply to people what is GDP? Because they talk about it, but nobody actually explains what it is.
Okay, yeah.
And this sort of second supplementary to that is, why are the UK figures worse than anywhere else? You know, so we see that, you know, China's growing again. America's GDP is down 6%, 8% in Europe, but 10% in the UK. So what's the reason for that?
Okay, so GDP is trying to measure, in simple terms, the size of the economy, so the wealth of the country. So it's made up of household spending, so everything that households spend, investment by companies, so again, what companies are spending, government spending, obviously government spends a huge amount of money on NHS and etc., so government spending, and it also includes net exports. So, you know, are we creating wealth by, you know, being net exporters? So if you add all of those things up, that's all of the income, all of the spending that we have as a country. Different countries, it will have different mixes. In the UK, we are quite consumer and service led. So a lot of our household spending is on consumer goods, whereas obviously in poorer countries, it's more on kind of basic essentials. We buy a lot of services, financial services, and we sell a lot of services overseas as well. So our GDP looks quite different to different countries. So if I look at the countries with the biggest GDP in the world, in the top 10 will be Qatar, United Arab Emirates, Saudi Arabia. So you can see where the wealth is coming from. Yeah, that's the oil wealth which is making them bigger. It's important also to compare it, you know, per capita, so divide it by the number of people. You know, if our GDP is going down slowly, but our population is shrinking, our GDP per head is going up. Yeah, so it's and newspapers often they'll quote the big headline number without the detail. And I guess the makeup of GDP also explains why our GDP has been slightly has done less well than other countries. We went into lockdown later than France and Italy and Spain. So their GDP in Q1 was much worse than ours. So ours is now worse because we're a bit behind them. Okay. We've also stayed in lockdown longer. Yeah. So our GDP hasn't come. You know, I mean, America. I mean, yeah, off you go again. So their GDP has recovered. China is an unusual case because it's such a huge economy and such a huge country that you can have a lockdown in a piece the size of the UK, and actually it's less than 2 or 3% of the country. So China is growing. It's on a very different trajectory. It's got a very young population and it's growing. There's also some evidence, you know, our retail sectors in the UK is a big proportion of our GDP, and it's been hit really hard, yeah, with COVID. So because of the shape of the way our GDP is made up, we look like we're worse than some other countries. If consumer spending comes back, it will come back very quickly, yeah, and then we'll recover quite quickly.
Yes.
Yeah. So it's a broad measure to try to say how big is your economy and are you growing or shrinking?
Yeah, good. Dan, thanks very much for your time today. Very much appreciate your thoughts and your input. I know that our clients very much appreciate your skills as a fund manager.
Okay, thank you.
Thanks to everyone who took the time to join us, and watch this space for the next conversation with. We'll be able to bring you a new broadcast every 4 to 6 weeks or so. If there's anything that you would like to hear about, please drop us a line and we'll do our best to bring the conversation to you. As always, if anybody has any queries or questions, please drop us a line. But thank you very much for joining us today.